When I was younger, one of the sports I really enjoyed doing was rock climbing. I found it to be very challenging, very rewarding, as you're able to make that grueling climb up. And if you were able to make it to the top of the mountain, you're often rewarded with beautiful views like you see here in this picture. An interesting part of rock climbing, though, is that most of the injuries and accidents don't occur while someone's climbing up the mountain, but it's when they're coming down the mountain. It's during that rappelling is when most of those accidents actually occur. Unfortunately, the same can be said for retirement as well. Many people make it to retirement. They reach that summit, they're able to retire. However, these days with increased risks, we're finding less people are able to make it to the end as more people are running out of money somewhere along the way. Now, there's a lot of reasons or risks associated with that. Most common ones that people cite would be longevity risk, as we know people are living longer these days and healthcare costs continue to go up, or even legislation risk, as we're seeing changes to Social Security and Medicare, and even changes to people's pensions. Today, though, what I want to focus on a little bit more is going to be the least understood risk to retirement, and this is what is called sequence risk. This has to do with the returns on your investments. So, what is sequence risk exactly? Simply put, it's just having a really bad look at the timing of your retirement. Imagine you're someone that retired in 2008, just before the global meltdown, and you retired, and the first year you had a huge loss of 50% or more. Just look at this graph here, it just helps illustrate it, where if you retire at that circle and in that first year or two you have major losses in your portfolio, it's probably going to make you feel pretty uncomfortable with your retirement, and rightfully so. So imagine that you were going to retire at age 65, and I told you you were going to live to age 95 and get a guaranteed 9% per year return on your monies. You'd probably feel pretty good and pretty comfortable with that retirement. Well, what you're looking at here is two very different retirements. Uh, the first one is the blue line here. That's a retirement that started in 1979 with a portfolio of $500,000 over 30 years. So going from 65 to 95, assuming a modest 4% withdrawal to live off each year, adjusted for inflation, that portfolio would have met all your income needs and grown from 500,000 to over $3 million during that time period. Now, if we look at the other retirement, that's a much less comfortable retirement. That's the yellow line there. Yeah, the yellow line represents the exact same returns, just in reverse order. So instead of starting from 1979 and working forward, we started at 2009 and worked backwards. And what you can see here is by having that big loss at the beginning of retirement, your portfolio never really recovers. But now, while you didn't run out of money, that's going to be a much less comfortable one than the blue line. So we talked about sequence risk and what it is. Let's talk about how do we handle that. Well, there's really two things that we can do. We can make more money or spend less. Now, looking at this make more money doesn't mean taking more risk. It actually means the exact opposite. It means having a balanced plan and taking some risk off the table, because at this point, it'll be more important to protect the assets than it is to grow the assets. So it doesn't mean we put it all in cash, but it means we have a balanced plan. So we want to be prepared with a plan that's going to allow you to be able to maintain a long-term focus. It's going to help keep the emotions in check. It'll make things less scary when the markets do turn south. And just remember, though, having a plan sitting on your shelf does you no good. Any plan is only valuable if it's acted upon. So by having the plan, it's going to allow you to follow a system and not act based on emotions. This is going to give you the greatest chance for success in retirement. Along with that plan, we're going to want to make sure there's three features there. We want to lower the risk, as we've already talked about. This is so you can meet your short-term expenses. We want to be able to diversify the portfolio. And that really matters now as we're at the later stages of this bull market, as most people believe, and we're seeing increased volatility. And finally, we want to look at rebalancing the portfolio. And this is especially important if you're a self-investor. It's the one thing a lot of individuals tend to forget about with their portfolio. What happens is a top performing asset class, like say the S&P 500 over the last 5 years has outperformed every other asset. So over time, that becomes a larger piece of the overall pie, a larger piece of your portfolio. So what you want to do is systematically rebalance the portfolio just to get it back in line with your target allocations. So aside from trying to make more money, the other option is spending less. Now, this doesn't mean penny pinching or having an uncomfortable or boring retirement. All we're simply trying to do is balance today's wants with tomorrow's needs. So here you want to be flexible with your spending on those big purchases. So if you got that big house remodel, that big vacation, the big car purchase, we just want to do those in the years where the stock market is up. So we're able to lock in some of those gains, take some money off the table, and do those things that you want to do. But in those years where there are losses in the portfolio, we may want to delay those big purchases just because we don't want to lock in those losses. And when it comes to spending in retirement, just keep this in mind. It's not as difficult as it may sound. The habits that you use to make you to be able to retire, those that made you successful, typically are going to be people that are going to be a little bit more conservative with their expenses to begin with. So those habits don't just suddenly go away for most individuals when they retire. Those habits that made them successful, they continue those habits into retirement for the most part. Thank you very much. Hope you enjoyed the recording today. If you have any more questions or would like to speak with us further, you can reach me, Paul Horn, at 714-282-1566. Again, my name is Paul Horn, 714-282-1566, or my email at the bottom of the screen there, Paul H as in horn at bfsg.com. Thank you for taking the time to watch this video, and please look at the others.